Hello and welcome to another video on my YouTube channel. Today I'm going to talk about the 20 stocks that are in the Swiss market index, the SMI, and their dividends. So the SMI, as I said, it's the Swiss market index on the SIX stock exchange. It measures the development of the Swiss blue chip equity market, and it contains the 20 largest and most liquid stocks traded on the SIX stock exchange. And the composition is fixed and weighed by their free float in the market capitalization, but it is capped at a maximum of 18% for the single components, so like Nestle and stuff. They are rather high percentage in the SMI, and that's why a cap isn't bad, I think. On June 30th, 1988, the index was standardized at 1,500 points, and as of Friday, so the 24th, it ended at 10,879.52 points. So that's on the 24th of November of 2023. And so the rise up till now is 9,379.52 points in more or less 35 years. It's 35.4 years, more or less. And that means that it has a rise of 625.3%, or annualized over those 35 years, and of course compounded, it's 5.75%. And then when you want to have the complete compounding of the index, you can also have the SME, that's the total return one. So you have the PR, that's the price, the SME price index. So the SME TR, that's the total return index, that's on 25,987.67 points. So you see it's almost 2.5 times as high as the SMI price index, and that's a rise of almost 24,500 points, and that's a rise of 1,632.5%, and annualized that's 8.4%. So you see the difference when you reinvest the dividends, and that's why I'm going to talk about the 20 stocks that are in the SMI index, and I'm going to go over them one by one. I'm going to go rather fast, so I'm not going to go into detail what the companies do and stuff. I'm just going to go over how they are with the dividends and which points are rather important by them for them. And then at the end of this video, I will give an overview of the complete stocks, so all 20 in one clear slide. You can take screenshots if you like then. And finally, it's the stocks ordered when I score them according to the 5 most important criterias that I'm going to mention. And I know it's not financial advice, so you should know that. It's just the information that I gathered. Those 5 measures, I always look at them, especially the first 3 that I'm going to mention. Those are really important for me. The other 2 are not that important, but I use them to score the stocks right now. But you have a lot more things to consider, so you have to look at in the future of the stocks in order to know for sure if you want them in your portfolio, yes or no. So by any means, this is not financial advice and not an advice to buy certain stocks. So the first stock, it's ABB Ltd N. The ticker is ABBN, and the ISIN code is the CH0012221716. That's the first stock. I'm not going to mention those things for the next stocks. So it's just so you know, just like for the ETFs, I always give this information on the slide for the ETFs and the stocks that I'm going to discuss. So currently the price is 34.13 Swiss francs. The dividend is 0.84 francs that they paid out in 2023. The dividend yield is in such a way then 2.46%, so not that bad. Then when I write here earnings per share, most of the time I took the diluted earnings per share because the diluted one is of course the better measure, because that's the actual earnings per share for the company. And for ABB it's 1.20 CHF, and this means that the payout ratio of the dividend from the EPS is 70%. And I know that you can have different payout ratios for the dividend, but for me it's always important that the dividend can be paid from the earnings per share, and when it's below 60% I'm happy. If it's below 40% I'm even happier, but that doesn't happen a lot of course. But between 40-60 it's good. Above 60 it's not so good, except when it goes above. Yeah, it's a company that is in real estate, or yeah, when it's really certain that it's going to have a high EPS anyway. So when then they pay out 90%, but it's 90% every year. That's then the same for the real estate companies that also pay out rather high payout ratios. So it's all the stocks have a different thing, of course, but ABB 70%, so on the higher side. The PE ratio, so the price earnings ratio, it's 28.4, and here for me it needs to be below 18. Be above 18 I don't buy stocks. So ABB for me, not a chance that I'm going to buy it. And then the dividends. So in the last 5 years there was a growth of 2.32% average growth for the dividends. As you can see here, the first 3 years of the 5-year period it was rather constant, and then it went up a bit. So we are at 0.84 right now, and in the past 18 years they paid out a dividend, so no breaks. And in fact they had a rise or an equal payout for the 17 years that followed the first payout of a dividend. So it's a nice stock in that regard. Then Alcon. So right now it's 64.66 Swiss francs. The dividend is 0.21, so rather low. So a dividend yield of only 0.32%. But then again, it's more of a growth stock, so it's for the future then. The earnings per share, it's 2.24. So the payout ratio is rather nice, 9.4% only. And the PE ratio is 28.9. So that's rather on the high side again. But when it's a growth stock, some people don't mind it. But as you heard me before with ABB, I mind. And then yeah, you see it. I can only talk about the last 2 years where there was a growth, because they only started giving dividends in 2021. And yeah, the first year it doubled. So in 2022 they gave 0.2 Swiss francs, and it went up from 0.1 to 0.2, so that's a growth of 100%. And then this year it went up another 5%, so together that gives an average of 52.5%. But if they can keep that up, that's of course another thing. The payout ratio is good, but it's a long way to go with only 3 years of dividend history. So up to the next. Geberit or Geberit. Momentarily it's 482.60 francs. The dividend is 12.60 francs. The dividend yield is 2.61%. The earnings per share is 20.41, and with this, divide that by that, you have a payout ratio of 61.7%, and the PE ratio it's 23.6. And the last 5 years there was an average growth of 3.96%, so it's okay, not that big. And they paid out 16 years of consecutive dividends, and the last 12 years were growth, because in 2011 they had a small reduction in dividend and then it went up again. But rather nice history as well for Geberit. Givaudan, it's a rather pricey stock, so 3,254. I talked about this stock a bit when in the video with starting again, I think, with CHDVD. Yeah, it's a pricey stock. The dividend is 67, so that's rather nice. The yield is 2%. The earnings per share is 92.51, so then the payout ratio becomes 72.4, so that's also rather high. The PE ratio is 35.2, so that's really high, and that's why I said in that video when I went over the components of CHDVD ETF, and I saw Givaudan rather high, that I didn't like Givaudan because it was overrated, and when you look at the PE ratio, that's certainly true. And I still think that it should halve in price for sure. So sadly enough, the ETF will take a knock then, but also that's why you invest in ETFs and not in individual stocks then. But Givaudan, not a stock that I would recommend buying. The last 5 years there was an average growth of the dividends of 2.93%. It paid out 23 consecutive years of dividends, and the last 14 years, so since 2009, the dividend is rising. So in that regard, it's really nice, but you see the growth is rather slow. So, and the PE ratio is much too high. Holcim. So the price right now is 63 and 0.06 Swiss francs. Dividend that it's paying out is 2.50 Swiss francs. So that gives a yield of almost 4%. The earnings per share is 3.66 for Holcim. The payout ratio is 68.3. The PE ratio is 17.2. So for me, that's just below my normal level, at which I say, okay, above that I don't buy. So just below 18. And the last 5 years there was a growth of 4.73% of the dividend, and they paid out 22 years of consecutive dividends, and the last 11 years, it's from 2012 that they started growing their dividend again. So they had a nice rise up until 2008, but then financial crisis came around, building crisis. So yeah, it suffered a lot up to 2012, and then it regained momentum. So nice stock, but the earnings per share next year, I think, are the prognose for, or how do you say it? The forecast for Holcim, the EPS, is not good next year. So in that regard, the PE ratio will shoot up. So that's another thing to consider, of course. Then Kuehne+Nagel. So the price 252.90 Swiss francs. The dividend is 14 Swiss francs. And with that, it's a really high dividend yield of 5.54%. The earnings per share are 22.03 Swiss francs. So the payout ratio lies around 60%, a little bit above 63.5. And the PE ratio is a nice 11.5. And the last 5 years, if you look at the graph of the dividends, it's a rather, bumpy ride. So don't be fooled by the 29.15% average growth. It's really nice to see that, of course, but in 2020 they dropped the dividend, and they paid it out later on the year as well than in the years before. So normally they pay out in they paid out in February, March. Then they started here they paid out only in September. So it's a bit tricky, this stock, because the PE ratio is nice, but as you can see, only 3 years of consecutive growth recently. So yeah, bumpy. Logitech, that's technology, of course. So price 74.52. The PE ratio will be higher. The dividend 1.06 Swiss francs, so a low dividend yield of 1.42%. The EPS is 2.23, so the payout ratio a little below 50%. I like to see that, of course. But then the PE ratio, 33.4. So not nothing to write home about. And the last 5 years, nice dividend growth. And if you look at the graph as well, really nice distributions. So the last 10 years it went up. Only the first year they I think they overrated the dividend a bit in that year. Maybe it would have been better that they only paid out 0.15, but probably they wanted to show that they were solvable and they could pay out the large dividend. But then of course the year after, yeah, they needed to pay out a lower dividend, and since then it's growing steadily and at a really nice pace. So nice grower, but the PE ratio is way too high. Lonza, so the price currently 350.50 Swiss francs. The dividend of 350, so it's a recurring theme here. The dividend yield of a flat 1%. The earnings per share is 14.71 Swiss francs. So a nice low payout ratio of 23.8% for Lonza, and a PE ratio of 23.8. So a bit higher than what you would normally recommend buying stocks for. And okay, the last 5 years, rather nice growth, 5.15%. Could be better, of course. Higher than 10% is always really nice. And the past 21 years they paid out the dividends, and for 19 years it is growing. So since 2004, years after, it was stable. And if you look at it, they are rather clever when it comes to their dividend distribution. So they keep it stable for 3 years. It goes up a bit. They can rise it a little bit more. Then it stays stable again for 3 years. Here again 4 years stable. 2 years a bit up. 3 years stable. 2 years stable. So they are a clever company when it goes about distributing their dividends. And that's something I really like to see. So Lonza, I'm always looking out whether or not it's dropping below the PE ratio of 18, yes or no. And it's not only the PE ratio compared to the EPS of last year, of course. So that's the reported earnings per share of 2022. So in the year report of 2023, that they reported in 2023. But you can follow every quarter what they are doing. And if you see that the earnings per shares are rising every quarter compared to last year, you know that this number is actually lower. So yeah, it's important to look at that of course as well. But I can't show everything in this video because otherwise it would be over 2 hours when I needed to go over everything. So Nestle, one of the best known dividend stocks in Switzerland, next to Roche and Novartis. So Nestle, momentarily around 100 Swiss francs. The dividend is 2.95 Swiss francs. So a dividend yield of just below 2.95%, so 2.94. An earnings per share of 3.42 Swiss francs. So the payout ratio is rather high, but as I said with when I started with ABB, it's a consumer goods company, so they have a rather stable income, so they can risk it to have a higher payout ratio. So it's always I don't like to see it, but for Nestle, you see it every year, so you get used to it when you invest in Nestle. The PE ratio is 29.4, so that's way too high. So definitely not considering to buy Nestle right now. Certainly not as as one of the satellites of our core satellite strategy. The last 5 years, 4.70% average growth of the dividend, and they paid out 15 consecutive years of dividend. I didn't find any other dividend history, so it can be that it's going on for longer, but I need to do a deeper dive then. If somebody of you know where I can find the rest of the dividend history of Nestle and the other stocks as well, because I try to find everything on the SIX stock exchange site, and sometimes there were data missing, so I looked those up for the time frames that I found immediately. But yeah, I think Nestle would certainly have been paying out before, so I'm missing information here. But yeah, 14 years of rising dividend as well. And just like Lonza, they are really smart about distributing their dividends and hiring it, so moving it up a bit. So clever company, good company, steady, but P ratio much too high right now. But that's the case with a lot of stocks right now on the stock markets. So maybe I should lower my threshold and say that it needs to be 28, that I can't buy above 28, but Yeah, it's difficult. Novartis, one of the other dividend names of the Swiss stock market. So currently 86.79 Swiss francs, a dividend of 3.03 Swiss francs that they paid out earlier this year, which means that they have a dividend yield of 3.50% almost. And earnings per share is 3.05 Swiss francs. So here you can see immediately that the payout ratio is rather high, also almost 100%, and the PE ratio of 28.5%, 28.5. So I think you can have a better choice than Novartis if you want to go that route of industry branch, and we will talk about that stock later on. So the last 5 years, an average growth of 5.37%, 22 years of consecutive dividend payments, and 21 were going up. So also really smart about their distributions, only building it up slowly so that they don't burn themselves and that they don't have to lower the dividend. I think they want to become dividend aristocrats with not the European norm, but also the American norm. So 25 years of consecutive raises or stable, of course. So Novartis well on their way. Partners Group, that's also a pricey stock. So 1,146 Swiss francs, a dividend of 37 Swiss francs, so a yield around 3.20%, an earnings per share of 39.09 Swiss francs, so also a rather high payout ratio, almost 95%, and a PE ratio once again almost 30, so it's a constant that we have higher than 18. Up till now, only one stock I think was below 18, or two I think, yeah, two. In the last 5 years, it had a really nice growth of the dividend, so 14.33%, and it's not as with the other one that had a bumpy ride. This one is really nice. So they started off low with I think it was two and a half, 3 Swiss francs in the beginning, and it went up all the way to 37 right now, and especially since 2014-15, it goes up really, yeah, really sturdy. So it has a really nice track record in the last 10 years. But sadly enough, P/E ratio is letting me down, the payout ratio as well. So, but yeah, Partners Group, it's of course more reality based, real estate based. So that can be an explanation here. But then again, yeah, I hope that the P/E ratio for this stock is going down, and then I can pick up some of them. But I think that it will be rather difficult. Richemont, so 112.10 Swiss francs momentarily, a dividend of 3.50 Swiss francs, so a dividend yield of a nice 3.12%. The earnings per share is 3.611 Swiss francs, and I made it orange right here because next year, so for 2023, they foresee a much lower earnings per share. So you have to take that into account. So everything what I say in this video, it's with earnings per share for 2022. We already had 3 quarters pass this year, so you can already form an idea of what the earnings per share for all these stocks are going to be. And for Richmond, it's not looking good. So now the payout ratio is almost 100%, but it will be surely over 100%. If they don't cut their dividends, that is, of course, because, yeah, we don't know what they are going to do. If they want to maintain their dividend and they are going to use cash reserve to pay the dividend, some companies do that, of course. A lot of companies do that. But yeah, the payout ratio is then going to be a lot higher. We will see with one of the next stocks that it can go easily above 100%. And then the PE ratio, it's not nice at all right now, so 31. And when the earnings per share drop next year, and when people realize it, that the earnings per share is not going to be that high in 2023, then the PE ratio is going to shoot up to 90. So the stock price will come down normally, but you never know, because yeah, the stock market is crazy sometimes. I will mention it when I talk about Swiss Re. So the last 5 years, again, average growth 25.09, really high, but it's because of these bumps here. So it dropped in 2020 and then it went up quite fast in the past 3 years. So yeah, what do you need to think about it? And then next year, when they are reporting the results of 2023 and the earnings per share is dropped quite a bit, then yeah, we don't know whether or not they are going to have the same and drop their dividend again. So let's see. Roche, 238.7 Swiss francs, a dividend of 9.50 Swiss francs, so a yield of 3.98%, so almost 4%. Really nice. So compared to Novartis, really, really nice. Certainly when you look at the EPS of 20.3, which means that this one has a payout ratio of only 46.8%. So Roche, in that regard, really nice figures. Also PE ratio of only 11.8. So another thing that is going for Roche. But then the dividend growth in the last 5 years is not that high. So it's rather stable. So from 2013 on, the growth is slowing down. So it went rather fast from 2002-3 up till 2013, but then it went slower and slower. But it's of course also difficult when you are paying high dividends to higher it even more. Sometimes it's quite easy. We saw we saw in the previous stocks some that really went up really high the last 10 years. But yeah, Roche, nothing to write home about. 2.745% growth in the last 5 years for the dividend. Then Sika, I made a mistake here, so sorry for that. But you can already see not that many dividends paid out in the last year, so only 5. The price is 237.3 Swiss francs, a dividend of 3.20, a dividend yield of only 1.35%, and an earnings per share of 7.29. So the payout ratio really nice, below 60% with 43.9, and a PE ratio sadly of 32.6. So yeah, building industry, it's I think it's highly overpriced. I'm going to disappoint a lot of people, but yeah, this price is really exaggerated. So it's I really don't understand how this firm can yeah, how do you say it? How they are worth 32.6 times their earnings? It's really a question for me. So then the last 5 years, a really nice dividend growth. So in that regard, nice dividend payers are of course always a bit overpriced, but a bit is not 32. That's maybe 20, 21, but 32.6, it's really crazy sometimes. And then yeah, it paid out 5 out of 5 years, and because it's not on the stock market that long, of course, and it raised its dividend 4 consecutive years. And as you can see, they are really doing it smartly, not too high payout ratio. So in that regard, I foresee a great future for Sika, but the problem is the highly overpriced stock right now. Then Sonova. So the price is 250.3 Swiss francs, a dividend of 4.60 with a dividend yield of 1.84, an earnings per share of 11.14. So once again, a nice payout ratio of 41.3%. The PE ratio, that's what I mean about a dividend stock being a little bit overpriced. 22.5, that's a really good PE ratio. And the last 5 years, yeah, 15.6% average growth of the dividend. And as you can see, it's doing a nice thing here. If you look at the data, of course, you won't see a dividend being paid out in 2020, but it was a stock payment in that year, and it had a value of around 3 Swiss francs. So I put it here, and if you look at it that way, it's an incredibly nice dividend paying company, Sonova. I think highly underrated for some people in Europe. They don't know it that well, but it's a really nice company. And if the PE drops again around 18, always buyable. Swiss Life Holding, it has a price of 563.6 Swiss francs. The dividend is 30 Swiss francs, and the dividend yield is 5.32%. So really high dividend yield. The earnings per share are 47.76 Swiss francs, and a payout ratio of a little bit above 60%. And the PE ratio, once again, 11.8. Love to see it. Swiss Life, one of the best dividend stocks available right now on the Swiss stock market. And the last 5 years, oh, that's not correct. I need to correct that. It's 15% average growth. So excuse me for that. It's because of this year in 2020 they paid out two dividends, consecutive dividends in that year, and I forgot to add them up the first time that I calculated it. So it's 15%, 15.7%, 15.70%. So sorry for that. And yeah, after the drop of 2008, from 2010 on, it only went up the dividend, and they are doing a great job as well in managing the dividend payments with a payout ratio of around 60%. Swiss Re, so 102.65 Swiss francs, a dividend of 6.40 Swiss francs, and a dividend yield of 6.23%. But as you know, in the beginning of the year, this was more around 8% because it was noted around 80 Swiss francs. It even dropped to around 73, 74, I think. And the earnings per share, it's in 2022 it was 1.63 Swiss francs, but the year before it was 4.5, and normally in this year it's going to go up again, so it won't stay at 1.63. But the earnings per share, it's, yeah, when they have some special events, of course, it's I think the same for the stock where the earnings per shares are going to drop to 0.53 that I mentioned earlier. Yeah, the payout ratio 3.93%. So they paid out a lot of their dividend out of their yeah, their savings that they have. And the PE ratio 63, it's crazy. But it was an exceptional earnings per share, of course, in 2022. So that's going to change 2023, but yeah, we always have to wait what it's going to give. The last 5 years, there was a growth of 5.17% on average. And as you see, from 2014 up to 2016, there was a drop in the dividend. And then thereafter, 7 years of dividend growth. And in the last 5 years, so 5.2% almost. Swisscom, another really important dividend paying stock on the Swiss stock market with a price of 515.8 Swiss francs. It's also one of the more expensive ones, but you saw the one with 1,100 and the other one with over 3,000 Givaudan. Uh, that this one is still rather okay, but still rather pricey when you can only buy complete stocks and not fractional shares like some other investors have the option to do in foreign stock exchanges. The dividend 22 Swiss francs, a dividend yield of 4.27%. And it's always brutto, so don't forget that you need to pay income taxes on your dividends in Switzerland. The earnings per share is 30.93 Swiss francs, and the payout ratio like that is 71.1%. The PE ratio, it's below 18, so 16.7, nothing to complain about there. But last 5 years, 0% growth in the dividend. So it's been flat for, I think, yeah, almost 10 years. So 22 Swiss francs the last 10 years. And yeah, they have a lot of costs, of course, to deploy 5G here in Switzerland. So that eats a lot of their earnings per share. And that's why they have a hard time in keep raising their dividends. But Swisscom, it's the best provider in Switzerland. They have the best coverage as well. Sunrise is really close, but yeah, Swisscom, the quality and the speed of internet connections is of course really good. UBS, there the price is 23.31 Swiss francs. It went up quite nice after they took over Credit Suisse. The dividend is 0.55 US dollar. I really don't like that they paid out in US dollar, but yeah, they are yeah, they are on the American Stock Exchange as well. So in that regard, I can understand that they pay out US dollar there, but they should change this here in Switzerland and pay out Swiss francs. Just an annoying thing that you receive for one stock US dollar. You have another stock that pays out US dollar, I think, in a real estate company that is related to the US market, and they pay out US dollar as well. But they pay out quarterly, and UBS doesn't do it. They pay out only annually, just like all the other ones. That's what I really don't like here in Europe and Switzerland, that all the stocks almost always pay out annually instead of quarterly. And I think they should consider changing that to quarterly payments, because people like it more to see more dividends coming in. It keeps them motivated to keep the investment going as well. Um, yeah, here in Europe and Switzerland, we are running a bit behind compared to America. In America, you have easily that you can do the drip. Here in Europe and Switzerland, sometimes you have other um, means at the banks to do drip and stuff in their own funds that they make, but doing it otherwise it's a bit more difficult. Some brokers do it, of course, but fractional shares, that's also a thing. It's always indicated that you should buy whole shares on the stock market. So your broker should then allow you to buy fractional shares. And yeah, that's a difficult thing here in Europe and Switzerland. The dividend yield 2.12%, earnings per share 2.03 Swiss francs. So this is going to shoot up, of course, with the yeah, the takeover of Credit Suisse. So they really profited a lot. They could buy it for only 8% of the actual worth of Credit Suisse, because Credit Suisse was in problems, as they said. So annoying for the Credit Suisse owners, stock owners, but really nice for UBS stock owners, of course. The payout ratio really nice and low, 27.2%, as it should be for banks. So I think that UBS is really doing a nice job there in keeping the payout ratio low. The PE ratio is also low, 11.5. So although it went up from 17 Swiss francs up to 23 right now after the takeover of Credit Suisse, it's still priced really low. And it's going to be even lower with earnings per share that is going to shoot up because of the profit that they made on the acquisition of Credit Suisse. And the average growth of the dividend, yeah, that's that's a bit of a disaster. So you see here in the last 5 years, because of this drop, yeah, it went down 0.27% on average. And yeah, 2 consecutive years of dividend growth, that's nothing to write home about. So yeah, if you when you count these two together, you see that the stock paid out, the company paid out a little less dividend in 2021 compared to 2020, and then two years of growth only. So yeah, it's not even past the 2019 marker. So in that regard, not a great stock. Zurich Insurance, that's the last one. A price of 435.8. It's a dividend of 24 Swiss francs, a dividend yield of 5.5%, so really nice. An earnings per share of 29.36, so a rather high payout ratio, 81.7%. The PE ratio is 14.8, so that's then nice, but payout ratio, okay, it's an insurance company, so they gather a lot of insurance money every year, every month of people. So they are also pretty sure about their income. And the last 5 years, there was a growth of 5.98% of the dividend, so almost 6% on average. And the last 14 years, so there was a drop in 2009 after the crisis, of course, in 2008, 2009. There was a drop there, and then it went up steadily. They kept it stable for a few years, and then it started creeping up. So the last 5 years, on average, 6%. And this is the overview. I'm not going to go over it completely. The thing Swiss Life holding that I'm going to mention, the average dividend growth, it was not 15.70 but it's 17.50%. So once again, I'm sorry about that mistake. And I gave points, so for the dividend yield, the higher the better. Payout ratio, the lower the better. PE ratio, the lower the better. So I ranked them, and then the best company got 1 point and the worst 20, and so I just gave 1 to 20. And then the raising or keeping it equal, the dividend, for so many years, the longer the better. And that's, of course, I know it's not nice to include Sika and give it low points because it's only on the stock market for 4 years. But I have to do it in one way or another. So yeah, it's a way of doing things that is not completely correct, but yeah. So the dividend yield, payout ratio, PE ratio, rising or dividend, and the average dividend growth. So all the points, you can see it here. You can take a screenshot if you want right now. And then when they are ranked, so yeah, calculating the totals. So 2 plus 10 plus 1 plus 17 plus 2 is 32. So from low to high means the best companies are on top. And yeah, you can see Kuehne+Nagel, Swiss Life Holding, Roche, Sonova, and Zurich Insurance are on top. And these are then again with the values. So I propose that you take especially a picture of this, or a screenshot of this screen. And although these 5 are on top, you have to look at all the pictures. So for Kuehne+Nagel, the payout ratio, and Swiss Life, the payout ratio is slightly above 60%, so you need to take that into account. The rising, so Kuehne+Nagel, only the last 3 years, bumpy ride, an average dividend growth of 29.15%, but as you know, it's because of the rather bumpy ride in the last in the whole trajectory of Kuehne+Nagel, in fact. So they fluctuate a lot with their dividend. So in the past 5 years, they did a really nice job of growing it, but yeah, it's here ranked first. But if you look at Swiss Life, in fact, that has a nicer track record with only the payout ratio slightly above 60%. Then Roche, where only the average dividend growth for the past 5 years is rather on the lower hand, but all the other metrics are really nice. Sonova, with the PE ratio of 22.47, a bit too high, but yeah, it's it's also a really nice growing stock. So 15.59% dividend growth in the past 5 years. And then Zurich Insurance, payout ratio bit high, on the high side. Average dividend growth around 6%. So I put it in green, but not in the dark green that I usually used for the other ones. So all nice points here. And then of course Lonza and Richemont, the prospects for the PE ratio, so the earnings per share, are not looking too bright. So the PE ratio is going to shoot up for those two stocks. And then for Swiss Re, it's the other way around. In 2022, they had a really bad earnings per share. So this one is going to drop again. In which degree, I don't know. But yeah, I hope you enjoyed this video. I know it's a rather lengthy video. I put a lot of time in it. I also made a few mistakes, but I'm not going to do a retake of this video because yeah, I put a lot of time in it, and recording then a video of 60 minutes, more or less. It takes a long time. I don't have the editing skills yet to edit my videos, so I always do it in one take, the videos, uh, on the hand of my PowerPoint. And I'm truly sorry that I made a mistake for Swiss Life Holding on the slide of Swiss Life, that the 17.50% wasn't noted there, and it was 55% of dividend growth there. But yeah, I forgot to change it. I changed it on the last four slides, but I forgot to do it on the slide itself of the company, so that's a rather stupid mistake. So once again, sorry. And with that being said, thank you for watching. I hope that you like the content and that you consider subscribing to my YouTube channel. If you want, also drop a like, and yeah, the notification, you don't need to do that. It's also annoying every time when you follow a lot of YouTubers and you have the notification turned on for all of them. You get a lot of rings, of course, so you don't need to do that. But if you would like to consider subscribing and hitting the like button, that would help a lot. So thank you and see you on the next video. Bye.